On the inflation side right now, I continue to be worried about where we are from an inflation perspective. We've been missing our mandate on the inflation side, our objective of 2% for more than 4.5 years. And I continue to see that we have pressure in inflation, both in the headline, in the core, and particularly where I'm worried about it is I'm seeing it in services. So a number of my colleagues have talked about the impact of tariffs and the fact that some of those pressures may just be a one-time price level movement that we should look through. When I start seeing pressure in the services side, things like insurance that feeds into our super core inflation, that to me says that maybe this isn't just coming from the tariff impacts, and it's something we need to be more attentive to.
Given that backdrop, do you think it's a mistake for the Federal Reserve to be cutting interest rates here?
It's a challenging time for monetary policy. We're being challenged on both sides of our mandate. So in the U.S., we have both an inflation mandate to maintain stable prices, but also maximum employment is the other side of our mandate. And right now, when I balance those two sides of the mandate, it's challenging. We're seeing a labor market that, to me, looks broadly in balance. It looks reasonably healthy. We're right around my estimate of maximum employment, that 4.3%. It's risen a little bit recently, but we've been in that 4 to 4.3% for really the past year. On the inflation side, however, what I see is inflation that's been above target for 4.5 years. My forecast is that we're going to remain above target for probably the next 1 to 2 years and not really getting back down to our objective of 2% until the end of 27 or early 28. And so again, to me, when I balance those two sides of our mandate, I think we really need to maintain a restrictive stance of policy so that we can get inflation back down to our goal.